Happy Thursday afternoon, almost Friday, December 1st, beginning of a new month. Glad to see everybody here. Hope you had a great trading day. It was a lot of fun where I was sitting, and hope it was for you as well. So let's get straight to it. We're going to talk today about using profiling to trade stocks, and I don't want to spend a whole lot of time on the front end. I want to get right into it. I want to look at some specific examples. If you've not been in one of these webinars before, or if you have and you know the question box, if you are a stock trader specifically and you've got levels in your head around a specific instrument and you'd like for us to take a look at it while we're doing this, just throw that ticker in the question box and I'll make sure that we try to cover that when we go to the examples later on. And so if there's something that you're trading today, or if there's something that you're looking at, I'm actually going to look at one example of a friend of mine who is all wrapped up in this one trade, and it's kind of funny. But we're going to look at that specific stock and talk about how to use this as well. But let's get into it, shall we? And have some fun. And I'm assuming that everybody can hear me. There we go. Okay, real quick, I don't have a camera today, but this is me. I'm Josh. I live in Fort Collins, Colorado, in northern Colorado. One of the beauties of the markets that we live in today is that you don't have to live in Chicago or New York or KC or San Francisco or Singapore to be involved in markets. You can live anywhere. And I live in northern Colorado. I'm Series 3. I work for a division or a branch of R.J. O'Brien, which is a futures brokerage, or they're a futures commission merchant. We're a futures brokerage, and I'm also an independent trader. I run managed futures and have been trading, for some time. And so, just a little background about me. I'm one of the mentors with the Trading Academy. If you're ever around us very often, you'll know my buddy Matt. Matt was the guy that introduced me to profiling, and is an exceptional trader, been doing it for decades. I think between the two of us now, we're about 35 years in markets. And we're doing all of this, really, the reason that we put these webinars together, the reason we do workshops and mentoring is that, we are partnering with traders who are looking for independent competence. Now, that's kind of our buzzword, but what that means is that you can sit down to a market and you can pick your entries, you can pick your exits, you know where you're right, you know where you're wrong, you know your strategies, you know how to tweak your system. You are completely independently competent. You don't need someone else. You don't need to be on their hip. You don't need to be going to Twitter looking for trade ideas like, oh, what do you think about this? Where's this price going to be? You don't need to look at CNBC and all that kind of stuff. You can shut all of that stuff off and you can just trade the markets. That was what I was looking for when I was looking to trade. And if that's of interest to you, beyond the scope of this webinar, you can talk to us. But that's why we're around. Okay. This is a concept that we hammer home over and over and over and over again, and it's a fundamental bias that we have when we approach markets, is that we're looking for the turn. Actually, we're looking for the trend before it is a trend, because everyone can identify the trend. I'm looking for, could I see where the trend started? Can I get in there? Because that's where I have the most opportunity to make money. It's not jumping on a trend that's already been there, but it's actually getting into the trend before it. And so, with this, as I approach markets, one of the questions that we get asked over and over and over again, specifically because we're the Market Profile Trading Academy, is, hey, profiling tools were developed in commodity and futures markets, so do they provide any edge in trading equities or other products? And what they're alluding to here is that, I don't know what your background is with profiling or auction market theory, but the tools that we're going to look at today were developed around the mid-'80s and based on the research of a guy named Peter Stottlemyre, who was at the Chicago Board of Trade and who was looking at commodities markets and trying to find a way to graphically represent what he was perceiving was happening on the trading floor. And the result of that is something we call auction market theory, and then the tools, the graphical tools that we use to discern that, what we call market profile and volume profiling, which we'll look at both of those examples. So because it was birthed out of the commodities markets and that being different than equities and driven in some sense by different drivers, I think it's a valid question. Does it provide an edge, or is it just something that really only applies if you're going to be in the commodity space? And if you're not, then don't play with it. Well, to answer this, what I would say is let's look at some of the consistent challenges that we have around trading stocks, and then let's look at some studies and some background, some statistics, and then see if what we find in the studies can support some of these challenges that we have trading stocks. So here are some challenges that I had when I started out, and I started out in stocks and equities. I'm exclusively in futures now. But here were some challenges that I had. One was determining bias. So like I'd sit down each day and I had no clue. Is it going to be an up day? Is it going to be a down day? Should I stay long? Should I be short? When should I take it off or not? And the thing that frustrated me is I'd get in, maybe I'd get long, I'd buy some shares, I'd buy a one lot, or maybe buy some equity calls, and then I would it would turn around and I didn't bail, and I'd like average down on a loser and then just really cause all kinds of damage. So determining bias and even shifts in bias was hard. Another one was who's in control, because one of the things I observed as I was trying to learn myself was why is it there are some days we have these massive moves and some days it just feel like we don't go anywhere at all. I mean, is there any way that I could predict that? That would be really helpful. If there was a way that I could understand, the length of the move or have some, that would all be helpful. And I think that's really around who's in control. I mean, it feels like, some days it just, you got the pedal down. And other days it's, we're not going anywhere. Another challenge that I experienced trading stocks, see if this resonates with you, is determining when the trend ends or begins. So, like I had some stock trades I got into and they were awesome. And then I get down the road and I don't take them off, and then I give back like half of my profit because I couldn't tell when the trend was maybe ending. And then I could see move, and then a trend starts and you're like, well, great, I saw it developed, but it'd been really great if I had seen it start. So that was a challenge around trading stocks. Another one is determining reliable support and resistance. We're always looking for levels that we can lean against as we're making trading decisions, and that's difficult. And people will use, oh man, I used all kinds of stuff from fibs to lots of fib spirals, Elliott waves, pivot points, floor trader pivots, all that kind of stuff, trying to figure out what can I lean against. And that was really another thing that was a challenge, was trying to determine price targets. So like I get in a trade, what am I targeting for? Like, do I just make it up? What's reasonable for me to expect going after this? And then finally, challenge that I had was, and this is kind of embedded in some of the others, is like, when was I right and when was I wrong? Because if you're right in the trade, you want to just press it and you want to stay in the trade. And then when you're wrong, you want to cut it and you want to cut it quickly. I mean, if you're going to be successful in markets, whether irrespective of what vehicle you choose to trade, whether you do stocks or options or Forex or commodities or binary options or whatever, knowing when you're right or wrong, I mean, that's significant, and so that you could take the appropriate action to cut your losers, let the winners go. So these were all challenges that I experienced as a trader, and I don't know if I'm assuming, having talked to lots of traders over the years, these are similar ones. If you can think of another one that's a common challenge out there, feel free to throw that in the question box. But these are the challenges. So I was looking for something that would allow me as a stock equity trader to have some edge around these. Now, with the Market Profile Training Academy, one of the things that we camp on and really try to hone in is that we like to lean on probabilities of what's likely to occur in the market and make contingencies for what could happen. And the challenge here is that when you first start coming to markets, you start learning how to trade, you don't know what's something like, if there were 4 bits of information that you put together to make a trading decision, you don't know which one has a really strong basis and should be leaned on that day and which one doesn't. So you're just kind of all over the place. So having probabilities around expectation of success is really, really helpful. So in the future space, particularly when we trade a lot in futures, again because of the marriage of profiling and auction market theory in the commodities market, also because Matt and I are futures traders. But we did some studies, and here's some interesting data that we've figured out. So, for example, if you take 1,000 trading sessions, there's a 95% probability that price will extend beyond the initial balance. Now, initial balance that's an auction market theory term. What that essentially means is the first hour of trade. So if you are trading equities, if you look from, I'm in Mountain time, but if you're in Eastern Standard, from 9:30 a.m. to 10:30 a.m., that is the initial balance, the first hour of trade. And you took that range from high to low, there's a 95% probability that price extends beyond that initial balance. Okay. Add to that if you go over 1,000 trading sessions, and by the way, 1,000 trading sessions is about 4.5 years. There's about 250 trading sessions a year, 250, 252, somewhere in there, and about 4 years of data. Looking at 1,000 trading sessions, 68% probability that price extends beyond this initial balance in only one direction. Okay, so 95% it's going to extend beyond this range, and 70% chance that it's only going to extend in one direction. So that means if I have an IB high and IB low, 70% chance, 7 out of 10, it's only going to exceed one edge of one of those extremes. Right? So that leads to something that we call a expectation that 68 to 78% of the time trading sessions present what we call a normal day type. What this means is that most of the day's range is contained inside of this initial balance. So, where does all this data come from? Well, here's a study that we built in some software called Investor RT from Linsoft. They really, really powerful software to be able to extract market behavior. Okay, and they got 3 products here. Now, if you don't trade futures, you won't know these products, but let's just look at them. So on the left, we have U.S. 30-year Treasury bonds. In the middle, we have crude oil futures, and on the right, we have S&P E-mini futures. So, S&P E-mini is a way for you to trade the entire S&P 500. You can trade it as a derivative product in futures. If you'll notice on these statistics, so we have 1,000 samples roughly of bars evaluated, and there is a IB breakout. So this is where the high side is broken out only, and the low side is breaking out. So if you combine these, you get for example, U.S. Treasury bonds, you get about 66% of the time, so 66 or 660 instances out of 1,000 where we only extend the initial balance range in one direction. And then about 30% of the time we extend it in both directions, and only 3.2% we extend it in neither, meaning that the IB completely contains the range. You'll notice that if we look at crude oil, very similar statistics. A little bit of variation, but fairly consistent. Same thing with the S&P. Okay, so this is a very helpful perspective when we talk about trading futures and using auction market theory, because we have hard data to suggest, hey, look, if I see the market open and I see that initial balance developed, that there's about a 70% chance it's only going to go in one direction. Look at this. Look at this. Actually, really, just to give you an example, what I'm talking about here. So this is a S&P E-mini market profile chart. So you can see this green line here, and if I actually expand this, all the market profile is a way to organize 30-minute price data. Okay, so each one of these sessions or periods is 30 minutes. They would, if it was a 30-minute candle, in fact, I can add 30-minute candles here. and you can see that, if this is what this looks like, it's just doing this by 30-minute period. Okay, so I have my 30-minute period. This first hour, so A period and B period represent the initial balance. Now you'll notice today we extended to the downside. Did we extend to the upside? No. So you got an early clue today in the S&P that once you saw range extension to the downside, that you had an opportunity to sell this thing. And you would know that you were wrong above A period. So then you start thinking through the statistics. Oh, this is one of those 30% chance times when it extends in both directions, and so then you have a clearly delineated area that you know that you're wrong, and then you can just let this thing ride. And just to give you point of reference, so say for example you sold at the range extension low at 94, and you covered at 87. Even if you covered at maybe if you didn't even go all the way down there, 4 points, for example, each point in the S&P is $50 per contract. So I mean, you're almost 10 points, almost a $500 move in the S&P, per contract if in futures. I don't trade the S&P because it's not that wide, but there you go. So that's what we look like in the S&P. Now, that all makes sense in the futures. The question is, does that work in stocks? Okay, well, I looked at 3 stock products that are highly traded, very liquid, just to see, hey, the stats hold true. I looked at Goldman Sachs, I looked at the SPY, the Spider, and I looked at Apple. Wouldn't you know it, that the stats are actually fairly consistent. We still have about a 65 to 70%. We only extend the IB in one direction, that we extend it in both directions. Actually, fewer instances in equities than there are in futures. So this is actually very powerful, meaning that if you see a range extension in one direction, very unlikely that it's going to extend in the other direction. And almost never does, I mean, this is a 12% Goldman Sachs, this is a 1.9% in the SPY, 10% in Apple, where it would extend neither the high or the low. Very, very powerful statistic. So, if we looked at nothing else, what I hope that this demonstrates is that yes, you actually can use this approach to markets and this way of organizing data to trade stocks and to trade stocks profitably. And here's how this specifically plays out. One, it'll help you establish bias using range extension of the IB. So here's an example. If we look at Apple today, okay, here's the IB. Which way did we extend the range to the downside? So if you came in today and you're like, I don't know what I'm going to do, like, am I going to be long? Am I going to be short? You can actually wait till the first hour of trade establishes. You can wait and see the range extension, and then you can go in that direction. Or if it rotates back up, you can sell and increase your cost. For example, like if you established getting short, either you shorted the stock or you bought puts as a way to get short that market. You could go all the way back up to 110.95, and hey, look, if it trades above that, I'm out. But I'll hold, and then you're in good shape. Also, in terms of bias, when I see range extension, that tells me that there is a time frame participant in the market who is exerting some control. When you see range extension, so if it's to the downside, that tells me that other time frame sellers, that participant is exerting control in the market. And so until I see other time buyers extending the range in the other direction, my overall bias is short. So that actually gave you a clue coming into the market today, is that yesterday, where was range extension? To the downside. So all right off the bat, when you started trading Apple today, you were coming in going, hey, look, unless I see range extension to the upside, my bias is short. And then same thing for tomorrow. Unless we see range extension to the upside that starts to counter this, then we'll be staying short Apple or looking for shorts. So that's one way in establishing bias. Another way that we can use it in trading stocks is using statistics to determine whether my hypothesis, determine my hypothesis and whether I'm right or wrong. So, for example, let's look at GS here. Okay, GS, massive move today in GS here. This is, for example, we call this a trend day. A trend day meaning that for each subsequent 30-minute session, we either have a higher high or higher low without a lower lower high. So it doesn't cancel out as it trades the whole day. I'll tell you from a hypothesis for tomorrow, the expectation is that we're just going to rotate. We're going to have a tighter range day in the direction of this trend in GS. That's the most likely behavior that we'll see. The next most likely behavior would be that we could move higher in another trend, but less likely. The least likely is actually that we would reverse. So, for the person who says, oh yeah, I'm going to sell GS and I'm going to get, massively short. Well, it could absolutely reverse tomorrow. It is not likely. Because what you have is you have an auction that is exerting a lot of pressure to the upside, where you have people who are buying this and they don't care what the price is. They just want to own Goldman Sachs stock. Okay, so in that situation, unless they get canceled out, and there's ways that we discern that through auction market behavior. For example, if we were to trade below 223.75 at any time tomorrow, that could be a bias shifting event in GS. But my expectation and the highest probability would be that we'll stay above that. So actually any pullbacks to this level without exceeding it would be a great place to buy to go higher. And then if you get below that, then you say, oh, we can have a bias shifting through the day. I'm wrong. I'll either get to the sideline, wait for the fuller pullback, or I can get short via short stock or puts. So that's a way that we use this in combining with statistics to determine hypotheses and then know whether you're right or wrong. And that's so crucial to know whether you're right or wrong based on your hypothesis. And again, it's a hypothesis, which is what? It's a best guess. This notion of trying to find perfect trading systems or find those that are 100% efficient is just not, it doesn't exist. You can find them that are 70% efficient, demonstrated even what we looked at earlier of, hey, 70% of the time we're going to extend in one direction. So there's a degree of efficiency that we can wrap around that statistically, but it's still somewhat subjective based on how wide the initial balance is. The wider that hourly range, the less likely we are to extend significantly beyond it. The tighter that range is, the more likely, if we exceed it, we're going to exceed it much wider. But that's another insight. Another one is that we can prevent style drift by leaning against probabilistic behaviors, for example, using value divergencies. So I want to look at another piece of software here. We're going to look at that Goldman Sachs move. Okay, so these are 30-minute bars. This is actually a volume profile chart that's showing me 30-minute bars. And on the right here, I have what's called a volume profile, composite volume profile that's 20 days of data, volume data. And this is volume at price data. So if you're typically used to seeing, and I can turn on volume bars of, and this is actually a cumulative volume bar, so it's not that helpful. But used to seeing that over time, that is not as significant as the volume that's spent at a price. This is very similar in the sense that if you're in a housing market, or even if you're looking at cars and what cars are priced at, they're going to price them efficiently so that they can move them, so they can get two-sided trade. If they keep moving the price higher, they're going to get less and less participation and eventually exhaust the auction. So what this allows us to see is it allows us to see how that auction's doing as it moves in a direction. One of the things that I'll call out here in GS that set up the potential for this move is look how many, and by the way, these green profiles, this is 1 week, so it's actually this full week of data. Here's this week of data. You can see we spent 2 weeks basically trading the same prices. So when you have that's a behavior that you have in markets or in any auction where we would call that a balanced auction, and there's a lot of price agreement, and that's how you see that the move is coming before the move starts. It's a lot of energy building up to then explore price somewhere else. And auctions, they're always wanting to advertise price. So what are we doing right now in the GS auctions? We're moving higher, we're advertising price, and we're seeing can we get additional activity at higher prices. And when I look at the composite for this 20-day, and I look at this over here is a 5-day composite, notice this 210.56, okay? This is the fairest price for the 20-day and the 5-day time frames. And look where price is currently. Now, this is a situation where we have price, it's forward moving, it's moving away from, it's trying to do price discovery away from known value. Now, think through this. Think if you were in a housing market and you see a whole bunch of houses sell at the same price. That would be akin to this thing happening. Okay, and now all of a sudden, prices are moving higher. Okay, what would you need to see happen to have confidence that prices will continue to go higher? You're going to need to see build out of not just higher prices, but also volume at those prices to support the auction moving higher. Because if the perception of value, and that's what we're graphically representing here, is the perception of value is much lower than where price is, if that can't shift, then we're likely to return back to a prior area of value if a market corrects, whether that be a financial market or a housing market. So what do we need to see as Goldman Sachs moves higher is we need to see more volume taking place and in trading at these higher prices. Now, I said that tomorrow we are likely to have a balancing day in the direction of this trend. If we do that and we spend all day trading around here, you can see how this peak right here in the composite will start to build out. We do that enough, and then what's going to happen is that this point of control down here is going to migrate higher. And what that's doing is that's confirming the auction is accepting higher prices. And then that can be a level that we can lean against for support as we move higher. And I like to look at these between multiple time frames. So, the 5-day is faster. So I'm going to see changes in that more quickly than in a 20-day. You can actually go out to a 90-day and a 180-day. What's really powerful about this is, one, there's very consistent behaviors that happen by looking at the auction in this form or fashion. So, if I see price disconnected from value, one of two things is going to happen. Either value is going to migrate towards price as we balance and build energy to move even further higher, or we're going to revert. So I can use that, and it keeps me from going, oh man, what's going to happen in this market? I don't know what's going on, because you can look against these consistently probabilistic behaviors. They're probabilistic behaviors because auctions, the way auctions work and the way people perceive value, it's like millennia old. It's almost as old as human history. People participating in markets or in the market, trading goods, they do this behavior over and over again. There's nothing different here in financial markets. And then one last thing that I would say about the benefit of using profiling to trade stocks is that you're going to actually capture some time back on your life. So listen to what I'm saying. This is a gift from the Lord for you to be able to look at markets and just look at the market generated information and not spend time running stock scans, running looking at CNBC, reading Benzinga, reading investing.com, all these things, trying to get some perspective on who's got news. Because here's the thing. I'm sure even on this webinar, there's some incredibly intelligent, cogent, capable people, but you are in and of yourself outgunned in the ability to have as much understanding of the fundamental drivers as markets as the capital that's chasing there, especially when we live in a low yield environment where there's really not vehicles that we can park money in to get lots of yield. So all of the yield in the world the capital in the world is chasing yield, and they're chasing a yield in these markets. So you're just not going to beat them by trying to think from a fundamental standpoint. And this is where I kind of have to chuckle. So I got a buddy of mine. In fact, I want to look at this. I want to look at this chart. And I'm going to send this webinar to him later because I think this is just hysterical. So he's looking at GSAT. I don't even remember the name of this company. There's some kind of satellite company. They're a telecommunications company, and he is reading all of these briefs on the FCC and what they're going to approve this company's technology and all that kind of stuff. And I was just kind of asking him. In fact, I need to go out to a longer time frame here to even see what's going on here, because this is a penny stock. All right. So these are daily bars. Each one of these profiles is 1 month volume profile. This is 180 days, and this is a 90 day. Okay, so you can see the point of control in this auction is $1.19. So my buddy, friend from college, he right now owns all of his shares at $1.40. Right, so he's significantly sized at $1.40. We traded 77 today, and he's telling me all the stuff. And here's the thing: if this thing's going to go back up to $1.40, it's actually not likely to go to $1.40 because it's going to get stuck here at $1.20, where we've done all the business in the world. I can predict behavior around that. In fact, I can predict and target 85 cents on this because I'm getting activity to take place in the auction there. But this auction is successfully auctioning lower, and it's doing a good job of getting lower prices. So I don't have to read any brief on this company to trade this. I mean, I can just say, hey, you know what? Like I'm gonna, if we get back above 85, then I might buy at 85, and I'm targeting first $1. I'll leave some for $1.20. But if we get closes back below 85, I'm taking it off. Like I can use these levels to lean against, and I don't have to study fundamentals. I don't have to follow people on Twitter to figure out who's got inside information and all that kind of crap. I can actually get some of my life back and do what most of us, why we got in trading for first place, was the lifestyle, so that we could go and like live instead of being all wrapped up in the game. Now, I get it. If you're all into the story and want to do that, that's great. I got all into the story with a couple companies in the past. One was Molly Corp, another one was Viringo, where I just got all in, oh, it's gonna pay off, and I basically just puked them eventually because it never paid off. So if you're in markets to make money, use auction market theory and profiling. If you're in markets to get wrapped up in the story of these companies, then that's fine. You don't need to make any money, and then don't look at any of the stuff. You can just read it, and then you'll tell us all the stories of when you found this one stock and it was a winner, and that's great. It's a little bit like fishing stories, but that's the deal. Okay, got a couple tickers to look at, so I actually want to take a look at some of these real quick. I have no idea what these companies are, but we'll see if we can pull some data here. So this is, let's find out who this is from Google. So Exact Sciences Corporation. So a couple things that are happening in this auction. I mean, you can see on a monthly basis, we're auctioning one time frame lower. We've got some decent support here at $11 on the 9-month time frame. On the 3-month, we're at $19.33. So this is kind of one of those situations where I see a mixed bias. You're kind of trapped between time frames, or values perception in time frames. I would actually love, and I'd probably set alerts looking at a couple places to buy into this stock. One would be 12.24. The reason why 12.24 is because that is a point of control if we go back to July of 16. I might add another at 10.11, guaranteeing that that's a point of control. And why I say point of control is there's predictable behavior that's going to happen as we move into this level, is because there's been a lot of volume that's taking place at that price. The auction's going to slow. It's going to give us an opportunity to make a decision. And then, from there, we will probably chop around before we make a move higher. So that's, that would be the place to get in. If we got, daily or weekly closes, pick your poison, below this level, then I would say peel it off, and you might be actually looking much lower. But that's how I would, if you were trading purely just buying stock lots, that's how I would trade exact science. Let's see, let's look at, oh, I mean, another way, I don't know what the premium is, but if I don't know if this product even has options, but you know, given that this is significant resistance above at 1940, if you could sell $20 calls, naked calls, sell them. And you're wrong if we close above 1951. So that, you know, that's a way. Other thing you could do is if they're puts, you could sell puts below 1099. You know, one, that's kind of the area that you want to own them anyway. And then if you're selling puts and get premium, you can actually, you know, get a cost basis that's actually below even where your entry wants to be. So it's a great place to trade that. Let's look at GDX. GDX. So we're looking at market vectors, gold miners, ETF. Yeah, so you can use this trade ETFs just as you can stocks. So looking at this one again, one time framing lower, I really don't see a bottom in this chart. And I'm also seeing on the monthly profile that we have a bearish skew. What I mean by that is an incomplete auction. So notice the orange here. That means that 70% of the volume at price has taken place is actually at the bottom of this range, and that the point of control here at 21.45. This auction's likely not exhausted yet. So you know, if you wanted to get long this stock, I'd probably set an alert at 19, and if it triggers, I'd come back to it. You know, it is possible that we could trade all the way to 14. There's really nothing here that would stop this auction at the moment. You know, to the upside, we've got some significant resistance here that we'd have to cut through. But you can see, you know, just by using these composite profiles, you know, we can very, very quickly, you know, very visually discern, hey, here's an area I want to lean into, here's an area I want to stay out of. One other one, LN. Okay. This must be a new stock. Not a lot of data here. I don't know who this is. Line Corporation. Is that who this is? You know, similar this month, much lower. Now we are. You'll notice on this one that the point of control actually is not quite at the bottom, and that there's a little bit of excess, meaning there's a little bit of trade that's taking place where we had low volume down here. If we can trade above 38.69 and hold that, I think you have a pretty decent chance of moving back towards this 42 level. Again, you could use this, you know, this low here as a stop and say, hey, if we trade back below that, then I'm out. You know, one of the things that we do with these points of control is we use those as levels of support and resistance. You know, starting this month, we're actually above that, so you can use that as an area of strong support to lean against to let the auction go higher, and you'd be targeting this 43 area. So, you know, not bad, about $5 move. You know, could be worth it. Okay, a couple other questions. When you measure the first hour of data on these futures contracts, is it when Globex opens for these things the night before, or is it during some span of time during the current day, like when the pits that no longer exist open? Yeah, so when I'm looking at the first hour, I'm looking at the open of what we would call the real-time hours or the pit session. And, you know, so if you're looking at equities, we're looking at stocks, that's going to be your 9:30 to 10:30 Eastern Standard Time. If you're, now futures have different session times. If you're trading bonds, you know, like I'm trading bonds at 6:20 Mountain, I'm trading crude oil at 7 Mountain, so 9 Eastern. You know, so those change, but from wherever that is, I'm marking that first hour, and that's how I'm coming up with that initial balance, and that is what the data was built on in this study. This is based on the first hour within equities. Let's see. The next question was what's Wednesday, Thursday? Profile for both days. So Nicholas, I see your question was it which product were you talking about? Oh, GS. Okay, so let's look at GS. You're talking about looking at this. And okay, so what's interesting about Wednesday and Thursday shape profile is that the LVN acts as an incomplete profile, low line profile, both days. Oh, using investor RT. Okay, let's look at that. And then we're going to go back and look at the, and look here. Okay, about Wednesday, Thursday, PC profiles the LVN as an incomplete profile. Yeah, I mean, both of these days, so these are both trend days, and you can see that the profile is skewed to the upside. So that right there suggests that this thing's going to move higher. It's got to go higher to exhaust the auction. Today, we did a little bit better. We got a little bit more excess, where we closed above the point of control. So, there is a potential tomorrow that we would come back and test 225. If we broke that, then, that could be a level that you can lean against to be short. But yeah, that's one of the ways we look at that. And, I don't have time to go in at length on this webinar on, all the different types of, behaviors that we see in auction theory. If that's something you want to explore more, I'd say, hey, go grab Jim Dalton's book, Mind Over Markets. Or if you want, I could send you a 300-page Chicago Board of Trade workbook that's kind of a self-study reference on looking at these different day types and how to discern them. And if you don't want to spend all that time and you want to really accelerate it, then just give us a call and let's spend some time together. So with that, I have covered everything that I wanted to look at. So if you have any more questions, feel free to throw those in. I'll land the plane. One, just kind of look at some homework. This is something that you can do if you want to look at this, specifically this IB extension example in stocks. Just pick a product, look for the first hour trade, watch for extension, enter and manage the trade, profit or loss, and get 100 samples. And the reason I say 100 samples is because if you're looking at a system that's 70% efficient, you may have a number of instances of which they're the 30%, and so you think it's broken. But just like flipping a coin, you flip enough times, you get 50-50. That's the rule of large numbers helps. Good. I got one more question. I'll cover that real quick. In February, we have the next edition of our quick launch workshop. Matt and I put this together. The whole MO of this is just to try to help accelerate traders towards where they want to be in proficiency and competence. So go to our site, look at marketprofiletradingacademy.com/workshop. If you have any questions about that, give us a holler. Also, we offer for anybody a free half-hour consult. You can schedule those you can pick, it syncs to our calendar. Just go to calendly.com/MPTA, calendly.com/MPTA, and you can pick a time to have a conversation with us. It's awesome. I just get an email that says, hey, you have a call with this person, and then I don't have to think about it. We can just have a great conversation. Markets are tough. Trading is difficult when you don't have a system to lean against. And if I can help you not experience some of the pain that I experienced trying to learn, that would be a real win for us. So think about that. Okay, we're going to look at one more example here. CC. Who is this, Nick? I don't even know who this is. You can tell I don't trade stocks anymore. Chemical comp. All right, so let's look at chemical comp here. First off, whenever I start looking at markets, I always look at a longer time frame. I look at a daily bars and monthly profiles. So a couple things I'm looking at with this company. One, you'll notice that last month, look at the point of control. It's at 2090. We're trading 24. So we are moving higher. Look where the 9-month point of control is. Look where the 3-month point of control is. So we're in a situation here where we're getting stretched in this auction. We're moving away from value. And in fact, if you look at this profile, look how it's getting thinner and thinner and thinner as we move higher and higher and higher. And then let's look at a 20-day. Okay, a little bit different picture. If you look at this last week, for example, we have a bullishly skewed profile, but notice where we closed today. So we closed below the point of control for the week. What I would say is, we've got this 5-day point of control here at 2062. Looks like the 20 days at 2078. So see, like all of our value references are below us. This one's going to turn first. So what I would do is I would watch the 5-day point of control and say, hey, look, I'm okay being long CC as long as we stay above this thing. If we break below or it closes below, then I think this thing could really topple quickly. So I just bear that in mind as I was trading CC. Again, if we got below this is where it's so cool, where you can use this to know whether you're right or wrong. Is I can say, oh, my hypothesis is we break this, then I'm gonna be short, and if we get back above it, I'll be, I'm wrong. It's really simple to do. You could say, hey, look, you could go ahead and sell this thing tomorrow and say, well, if we get above 24.76 on the close, then I'm wrong being short, because then we're going to continue higher. So you can use these differing time frames and perceptions of value to help you make decisions. I do that all the time. In fact, let's look at NASDAQ futures here, for example, real quick. It's thinking. Okay, had a trend day down in NASDAQ after another trend day prior. Look where we are. We're below the fairest price on 2 time frames here. We are also below fairest price on a 20-day and a 5-day. So I think this thing's got to prove it's going to go higher, but there's a lot of resistance above the NASDAQ at this point. So if you're a triple Q ETF trader, I don't think this is buy the dip. I'd want to see us. I'd want us at least above 47.69 before I'd feel really great. Actually, I'd want to see us back above 4,800, because that's the more powerful reference. Corresponded to, this is NQ. I mean, what's interesting, this also I think validates why you can use profiling for stocks, is that if I look at the triple Qs, it's the same profile. It's just the prices are different. In fact, before I moved to futures, I actually traded triple Qs as a way to trade NASDAQ futures. It was, because they move in tandem. Because the NASDAQ futures are a derivative that allow you to trade a nominal or a notional value of triple Q ETF. So same thing. So to sum up, yes, profiling is an effective tool. Auction theory is an effective approach to trading stocks, the same as it is in trading futures where it was birthed. So lean on that, learn the profile, and hope you get some great benefit of it. Question about news and technicals and aka prior price, all that kind of stuff. It's I stopped looking at any kind of news. I could purely just look at the auction and what's going on. And think about this. And in fact, we're going to write a book that we're going to release in the beginning of the year. And the book is, hey, you already know how to trade, you just didn't know it yet. and the reason for that is, we all know who. If you think about, if you've ever been to an auction, maybe it's an art auction or an estate auction or something like that, who wins? How do you win in an auction? You win by buying below value and selling above value, or you win because there was some item that you just wanted and you don't care what the price is. So if you even start there and think about that dynamic, when you look at the behavior and think of it, what I'm looking at when I look at a chart is I'm looking at a live continuous auction, and those types of behaviors are there. There are people who just want to buy below value and they want to sell above value, and there are people who just want to own it because they just want to own it and they don't care what the price is. That is a very powerful concept to think about. Okay, Well, we're gonna land the plane unless I'll give like 30 seconds for any other questions because I've committed to do this for an hour. But other than that, I'm gonna wrap it up and get ready to go see my son play basketball. We're starting high school basketball. It's gonna be awesome, a lot of fun. Thank you all for your attention, and thanks for just the great questions. Really appreciate it. Talk to us. Love to help. Don't no reason to keep fooling around. With markets. Like, let's get it done. Let's go after it. Last question. Plans for NFP. So tomorrow's non-farm payrolls. Which thanks for the reminder. So non-farm payroll is what I would call a binary event. If you're trading stocks, this is like trading around earnings. So what I mean by binary event is that you have absolutely no way to predict, is it going to be up or down? So, in the futures world, because we don't have earnings, we look to things like economic releases, and non-farm payroll is one of those. It's the employment situation. It's an indicator of the economy. Tell you what, I don't trade them. I stay on the sidelines. I stay on the sidelines for oil inventory reports until after. So I typically will let the auction kind of do its thing and shake everybody out, because what happens initially is everybody's trying to jockey in position. If you want an equity example, go back and look at 1 minute data on the last Apple's earning. You'll notice that it just jumped off the release and then it hammered. And I actually had CNBC in the office going on, just for more entertainment than anything. And here they are. They're like, oh, it's going to spiking higher. Oh wait, no, it's because they don't know. They don't know anything. Whenever you have a binary event, the auction's just it's everyone's trying to posture, and the auction is trying to run people out. So stay away. Let the thing settle, and then you can lean against the auction. I'll be recording the auction, I have been recording this, and I'll post this, send it out via email to everybody afterwards. And if you have any questions, after reviewing it, or after you get the recording, just shoot me an email. Be happy to help. Okay, guys, that's it. Thanks for the great questions. Thanks for the attention. Have a great Friday and great weekend in preparation for the holidays. Happy holidays, everybody. And we'll be looking to do another webinar here in a couple weeks, and then really getting ready for an awesome 2017. So, and I hope that's where my mind is just to have a great 2017. 2016 has been my best trading year ever, and looking to do more of the same 2017. So hope for you as well. All right, peace, everybody. We'll talk to you soon.